This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
As promised, we're now joined by Todd Lutsky from the law firm of Cushing & Dolan. The segment is Ask Todd, and it's your chance to speak with Todd Lutsky live on air about your estate planning questions. Phone lines are open at 888-205-2263. We got plenty of room on them right now, but they do fill up. In the last couple weeks, we've not gotten through all of the calls, so get calling early to make sure you get in line and we can get to you. Again, that number is 888-205-2263. That is the number to call to speak to Todd Lutsky about your estate planning questions. Again, it's 888-205-2263, and we'll get to your questions in just a little bit. One more time, 888-205-2263. Mr. Lutsky, how are you doing today?
I am doing fine. I'm afraid to ask you, though.
I'm good. Did you see there was big news yesterday?
No, what happened?
I'm kind of a dinosaur geek.
Oh, you are?
Archaeologists, they just found a fossilized dinosaur fart.
Well, no, I didn't realize that.
They called it a blast from the past. Just very exciting news. Todd, I want to talk a little bit about emergency nursing home situations. Let's say that someone is in a case where they didn't necessarily do any planning, and now they have a long-term care situation that is imminent.
Yeah.
Is there a scenario in which it still makes sense to do updated estate planning documents, including trusts, as you are heading into a long-term care situation?
So, generally not the normal estate planning trust that you would think about, right? That's probably too late for that because, like, the Medicaid irrevocable trust that we reference in the guide and things like that, you need, there's a 5-year waiting rule that many of us have learned about in the past, and so it's hard to overcome that. But there is, and it is somewhat breaking news, the pooled trust, which, by the way, was around for my whole career as practicing in the elder law world, and then in, I believe, March of 2024, it went away by legislation, or it went, they took it away as an option.
So just earlier this year.
And then lo and behold, effective now, I think it's effective December of this year, pooled trusts are back. By legislation, they actually decided to pass a law and not allow these regulations to apply anymore, and they went at the legislative level here in Massachusetts. They've brought back pooled trusts, and that would be the kind of trust that you're referring to here, Chuck, I believe. So,
what is a pooled trust?
A pooled trust is one that we actually don't even prepare, but when you're applying for Medicaid in the scenario you mentioned, that's when these would come up. So like a financial institution would prepare this pooled trust, and then there's this charity called Plan of Massachusetts and Rhode Island. They're the charity. They serve as trustee, and then this money gets put into this trust along with other people's money, and it gets invested and managed. For who? For the person who put it in. And that money can be used for their benefit. But the key is that by transferring it into this pooled trust, there's no 5-year waiting period. So again, last minute, you as you mentioned, you're going into the nursing home. This is when you would use this. And then there's no 5-year waiting period to put it in. The catch is that there's a payback provision. So when you pass away, if you've been in the nursing home for less than 2 years, then you need to not only give 10% to charity, Plan of Massachusetts and Rhode Island, and repay the state for your care that you received, benefits that you received, again, at a Medicaid rate, way better, and then the balance can go to the family. Or if you've been in there for 2 years or longer, then you got to give 20% to charity, pay back the state, balance to the family. Still, it's a wonderful way of getting on Medicaid last minute and leveraging private pay against the Medicaid rate, and everybody wins, from the nursing home to the state to the family to the applicant.
Talking with Todd Lutsky from the law firm of Cushing and Dolan. If you have a question to ask Todd about your estate plan, still room on the phone lines at 888-205-2263. That number again is 888-205-2263. We're going to take a quick break here, but when we come back, it's going to be right to your questions with Todd Lutsky. So again, still some room on the phone lines at 888-205-2263. When we come back, right to your questions with Todd. That number one last time is 888-205-2263.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. Todd Lutsky answers your questions about estate and elder life planning every Wednesday at 10:30, right here on the Financial Exchange Radio Network.
Still room for one more call for Todd Lutsky at 888-205-2263. Let's go now to our first caller, though, Mark in Boston. Mark, what is your question for Todd?
Hey, how you doing? Thanks for taking the call. Quick question. I just set up a will and a trust, a revocable trust, and I've got my home. I own my home, and it's in an LLC. I've got some life insurance and stock stuff, but everything, the beneficiary of everything is the revocable trust. Now, what do I have to do to protect this and all my stuff against the nursing home? Can I drop that in a revocable trust, or I'm just kind of lost on this?
Yeah, let me. And interestingly enough, and for everybody listening, it just sounds a little like, Mark, you're kind of all over the place. So let me. You said a lot of things that mean a lot of things to me legally. So let me ask you a couple of clarifying questions. One, and the one that's most disconcerting to me is that you said your home, your primary residence, is in a limited liability company. Is that correct?
Yes, it's a multi-family home. So we put it. Put it in an LLC.
I can understand why you did it partly, but the thing you need to really remember, and I generally don't do this, is even though it's a two-family or a multi-family home, I get that you're renting it and you want to protect it, but when you put it in an LLC, you immediately lose any of the capital gains exclusion that you would get if you were to sell it. So if it's a two-family home, 50% of the gain would be, if you're married, 50% of the gain would be allowed or available to shelter up to $500,000 of that gain from taxes. You lose that immediately by putting it into an LLC, because now you're telling the government that it's not my home anymore. It's now a commercial residential property. So that's something we might want to fix. Obviously, I get the protection side of it, but you might want to have a lot of umbrella coverage on insurance. Umbrella insurance could maybe help with that. Then the other piece would be, it sounds like everything else is centered around your revocable trust. So depending on how much you're worth, right, not everybody needs to do irrevocable trust. I mean, if you're self-insured for the nursing home, then you probably don't need to worry. But depending on the size of your estate and your age, like 60 and over is sort of what I think about in my head when I mention this to clients. But if you're in that category and you want to protect assets from the nursing home, then we would completely get rid of what you have and you would start fresh with an irrevocable, or if you're married and you're worth more than $2 million, then 2 irrevocable Medicaid trusts, and we would take your house and put it in that new trust. Whether it stays in the LLC or not, we would have to discuss. I don't love the idea, but we certainly can do it. And along with some of your investment portfolios, not IRA accounts, not retirement accounts, and we would put those non-retirement accounts and some of your real estate into these irrevocable trusts. And that's the way to go to provide the protection from the nursing home while continuing to get the benefits of avoiding probate and eliminating or sheltering or reducing your estate tax, both at the federal and the state level. So, and of course, providing for your family. So it does everything the revocable trust does that you have, but it adds nursing home protection planning. So that's probably the way to go for you, Mark, and you can figure out how best to do that. Reach out to an estate planning attorney, and they can help get your ducks in a row. That said, Mark made us touch on 2 of the top 7 estate planning trusts. Mark mentioned the revocable. I came back with the irrevocable. Those are 2 of the top 7 estate planning trusts mentioned in this guide this month. And there's others, from irrevocable life insurance trusts to sole benefit trusts to special needs trusts. But we think the top 7, not only from a tax perspective does it explain it, it explains it how it operates. And most importantly, if you've never done your planning, get this, learn which trust might be right for you before you go in to see the estate planning attorney. And if you've already done your planning like Mark, maybe get this and learn how shifting from a revocable to an irrevocable might be right for you. 866-848-5699 or legalexchangeshow.com. Again, 866-848-5699 or legalexchangeshow.com.
Todd, we've got another one queued up for you here. Let's go to Mike on the Cape. Mike, what is your question for Todd Lutsky?
Mr. Lutsky, I'm a 78-year-old and my wife is 69. We have property and we have a few $100,000 in the bank, but my wife refuses to get a trust or a will. I don't know what to do about it. I've tried for a couple of years now, and I'm not getting any younger, so I'm not sure what to do. If you've got any answers for me, I would appreciate it.
Yeah, so that is a complicated situation, right? Because when clients come in, and I've had a few of these, not many, but when clients come in, I always say I want both clients. Sometimes like a husband or a wife will come in, and they'll say, "Oh, my spouse is not interested in this. She'll just do, or he'll just do whatever we decide to do." Or, and if that's the case, I always tell them, you know what? I really want to have the meeting with both people here. Why? Because it's not about numbers. It's not about taxes. It's not about probate. While it is about those things, it's really about the family behind the estate plan. And I need to understand what their wishes are and who they want to be, and not only who they want to be fiduciaries, but also to understand how a trust works when one person passes away, because the other one might be the survivor, and they need to know how it works. So I generally want both there. Now, that said, in your case, you sometimes get people who just don't want to participate. That doesn't mean that you can't do an estate plan for yourself. As long as we know we're only representing one party, we can do that. You can come in and you can set up a trust or a will. Again, you probably need more than just a will, and at least deal with the assets that you have access to, or your half, or, and get some of the stuff in the trust. And remember, we're not going to disinherit your spouse, but to the extent possible, you can provide for your spouse through your own estate plan. So I'm going to say you could probably do estate planning for at least some of the assets and try to take care of you, your family, and your spouse, even though your spouse isn't technically participating in that plan. So that might be a way to look at that.
Todd, earlier we had talked a little bit about the idea of, hey, do you update your estate plan if you have an imminent long-term care situation? I think we covered that decently well. But
yeah,
as far as what else you can consider if you have an imminent long-term care situation, what are other options that might be on the table for people depending on the situation they find themselves in?
So if we're looking at, this is last minute again?
Yes.
So if you're looking at last minute, the pooled trust idea is really the way to go when you're older and annuities don't work. Short of that, if you're married, and this is an important part of the pooled trust, if you're married, you likely will never do the pooled trust. Why? Because if you're married, you're likely going to have that one spouse at home. And if that spouse is at home, now we have options because that spouse can have all the excess resources. So if you're faced with nursing home planning and you have a spouse at home, you can take all the excess money over $148,000 and change for the healthy spouse and $2,000 for the sick spouse. So the first $150,000 of assets you can reach in, take out, and give to the healthy spouse. The excess, regardless of how much it is allowed to come over to that spouse. We wouldn't need the pooled trust. We instead would buy a Medicaid annuity for the healthy spouse. converts those assets into an income stream for the spouse, thereby taking what once was a countable asset and making it non-countable by converting it into a stream of payments, a stream of income that they get. And that technique would allow the sick spouse to become eligible for Medicaid right away. So that's when you use a pooled trust and when you would not use one.
Mr. Lutsky, thank you so much for joining us today.
Always a pleasure. Thank you.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated.